Tomorrow morning, something unusual is going to happen on the Nasdaq. A company that has launched more rockets than any nation on Earth. A company that runs the world's largest satellite internet network, holds classified defense contracts, and is actively building the vehicle meant to carry humans to Mars, is going to become available to buy for the first time. For the average person with a brokerage account and a few $100s, this is genuinely new territory. Not because SpaceX is going public, that part you've heard about, but because most people sitting in front of their phones tomorrow morning have never bought an IPO before. They don't know what the mechanics actually are, what the risks actually look like, or whether the excitement they're feeling is a good reason to act. This video is for that person. Not the hedge fund manager, not the accredited investor who's had shares for 2 years. The regular person who opened their Robinhood app this week and thought, should I be doing something? Let's answer that clearly, starting with what this actually is. Part 1. What an IPO actually is, and why it matters. Before we talk about SpaceX specifically, we need to make sure we're speaking the same language, because IPO is one of those terms that gets thrown around constantly in financial media without anyone stopping to explain what it actually means for you. IPO stands for Initial Public Offering. It is the moment a private company, one owned by founders, early investors, and employees, decides to sell a portion of its ownership to the general public through a stock exchange. Up until that moment, you cannot buy shares. There is no ticker. There is no price. The company exists. It operates. It earns revenue. But ownership is locked behind walls that most ordinary people cannot access. When the IPO happens, that wall comes down. Shares become available on a public exchange, and anyone with a brokerage account can theoretically buy them. That is the moment happening tomorrow with SpaceX. SpaceX has priced its shares at $135 each. The company is targeting a valuation of approximately $1.77 trillion, which would make it the second most valuable company in the United States on day one, behind only Apple. It would also represent the largest IPO in the history of the stock market, surpassing Saudi Aramco's $29 billion raise in 2019. SpaceX is targeting $75 billion. Those are enormous numbers. And for a beginner investor, enormous numbers can feel like a signal to act fast. That instinct is worth examining, because it is often the most expensive one you have. Part 2. The business. What are you actually buying? Before you can decide whether something is worth buying, you need to understand what it actually is. And SpaceX, despite its name, is not simply a rocket company. It operates across 4 very different business areas. The first is launch services. SpaceX's Falcon 9 rocket completed over 130 launches in 2025 alone, making SpaceX responsible for more than 80% of all U.S. rocket launches. This division generates billions in revenue from government contracts, commercial satellite operators, and NASA partnerships. The second, and currently the most important from a financial perspective, is Starlink. SpaceX's satellite internet service now has over 12 million subscribers across 160 countries. Starlink generated an estimated $10 billion of SpaceX's $18.67 billion in total 2025 revenue. It is the only division currently operating profitably. It is the engine that funds everything else. The third is Starship, the largest and most powerful rocket ever built. It has no paying passengers yet. It has no operational commercial flights yet. But it is the vehicle SpaceX is building to dominate deep space transportation, lunar missions, and eventually Mars. This is the speculative engine of the SpaceX story. The reason analysts attach a $28.5 trillion total addressable market to the company's ambitions. The fourth is national security. SpaceX holds classified defense contracts whose exact value is not publicly disclosed. This adds a layer of revenue stability that doesn't appear in consumer-facing financial summaries. Now here is the financial picture that the prospectus actually shows, and it is one the excitement around this IPO sometimes glosses over. SpaceX grew its revenue by 33% in 2025, reaching $18.67 billion. That is genuine, impressive growth. But the company also posted a net loss of $4.94 billion in 2025, a reversal from $791 million in profit in 2024. The loss is largely attributed to the acquisition of Elon Musk's AI company, xAI, earlier this year. So what you are buying is a fast-growing, strategically important, operationally dominant company that is currently losing nearly $5 billion per year. That context matters. We'll come back to why in a moment. Part 3. How to actually buy it. The honest breakdown. This is the part most finance content skips past, which is frustrating because it's the part beginners actually need. There are 3 realistic ways for an everyday investor to participate in SpaceX going public. Each one works differently, costs differently, and carries different risk. Option 1. Requesting IPO shares directly through your brokerage. Several major brokerages, including Robinhood, Fidelity, and Charles Schwab, are offering retail investors the chance to request shares at the IPO price of $135. Here is how it works. You submit what's called a conditional offer to buy, or an indication of interest through your brokerage's IPO section before the offering closes. You're essentially raising your hand and saying, "I would like shares at $135. But here's the catch, and it's an important one. You are not guaranteed to receive shares. Allocations are limited. Demand almost certainly exceeds supply. And different brokerages have different eligibility requirements. Fidelity requires at least $2,000 in your account. Charles Schwab requires at least $100,000 in retail brokerage assets to participate. If you do receive an allocation, you pay $135 per share. That's the IPO price. If your request is not filled, which is possible, even likely for small accounts, you don't automatically get shares. You would then have to buy on the open market after trading begins. Option 2. Buying on the open market after trading starts. This is the option available to everyone, regardless of account size. Once SpaceX starts trading on the Nasdaq, you can buy it like any other stock through any brokerage in any amount. The risk here is price. On the first day of trading, IPO stocks often open significantly above their offering price. Based on historical data, IPOs with this level of demand can open 20%, 30%, or more above the price set the night before. Meaning, the institution that paid $135 might be selling to you at $160 or $170 in the opening minutes. That is not a scam. It is how IPO market dynamics work. But it means you could be buying at a substantially higher price than the headline $135. Part 4. The risk side. What hype leaves out now, we need to talk about what the excitement doesn't mention. IPOs, as a category, have a well-documented track record that surprises most people when they see it. Jay Ritter, a finance professor at the University of Florida, who has tracked every U.S. IPO since 1980, found that the average IPO from 2012 to 2021 gained 23.6% on its first day of trading. That sounds great. But the average 3-year return on those same IPOs was just 10.6%, significantly below what a basic index fund delivered over the same period. The pattern is consistent across decades. IPOs tend to have exciting opening days and disappointing medium-term performance. The initial pop, reflects enthusiasm. The subsequent drift reflects the market working out what the business is actually worth. SpaceX may be different. It has real revenue, real infrastructure, and real market dominance that most IPO-era companies don't have. But it also carries risks specific to its situation that deserve to be named clearly. Risk 1. The valuation assumes a future that hasn't happened yet. At $1.77 trillion, investors are not paying for what SpaceX earned last year. They are paying for what SpaceX is expected to become: a company where Starship is operational, where space-based data centers are a real revenue stream, where the company's claimed $28.5 trillion total addressable market is actually realized. Morningstar, one of the most respected investment research firms in the world, has already stated publicly that it believes SpaceX is significantly overvalued at the $135 IPO price, placing its fair value estimate at roughly $780 billion, less than half the offering valuation. That doesn't mean Morningstar is right and the market is wrong. Analysts disagree about SpaceX's value precisely because so much of it is speculative. But a $1 trillion gap between what one serious analyst estimates and what you're being asked to pay is worth sitting with before you act. Risk 2. The company is currently losing money. The $4.94 billion net loss in 2025 is real. It is primarily attributable to the xAI acquisition, which merged Elon Musk's artificial intelligence company into SpaceX's balance sheet earlier this year. The integration of a new and expensive AI division into an already capital-intensive aerospace company adds complexity and cost that wasn't there 12 months ago. Part 5. The bigger picture, what actually matters for you. Let's step back from the ticker for a moment and talk about you specifically. Because the SpaceX question, should I buy it, and how, is actually a smaller question inside a bigger one. The bigger question is, what role should any single stock play in your financial life? Here's the honest answer that behavioral finance research consistently supports. For most people, especially beginners, the foundation of a healthy investment portfolio is not individual stocks. It's broad, low-cost index funds that own small pieces of hundreds or thousands of companies spread across the entire economy. The reason is simple. No single company, no matter how exciting, is guaranteed to perform. Even great companies, ones with real revenue, real competitive advantages, real visionary leadership, can disappoint investors for years if the price they paid was too high relative to the actual results. The history of finance is full of brilliant companies that made terrible stock investments at the wrong entry price. An index fund, by contrast, doesn't bet on one company being right. It bets that the overall economy, over time, grows, which is a bet with a much longer and more consistent track record. And here is a detail worth noting. Once SpaceX joins a major index, which under Nasdaq's updated rules could happen within 15 days of its debut, every investor holding an S&P 500 or Nasdaq 100 index fund will automatically own a piece of SpaceX. Not as a concentrated bet, as one small component of a diversified portfolio. For many people, that's the most appropriate form of SpaceX exposure, and they'll get it without doing anything at all. Now, does this mean you shouldn't buy SpaceX directly? Not necessarily. If your financial foundation is in place, if you have an emergency fund covering 3 to 6 months of expenses, if you're not carrying high-interest credit card debt, if your regular index fund contributions are automated, then allocating a small, defined portion of your portfolio to a single high-conviction position is a legitimate strategy. The keyword is small. 5%. Maybe 10%. If your risk tolerance genuinely supports it and you understand what you own. An amount where being wrong is uncomfortable but not catastrophic. Where being right is meaningful but the portfolio doesn't depend on it. If SpaceX goes to $200 and you had 5% of your portfolio in it, that's a nice outcome. If it goes to $80 and you had 5% of your portfolio in it, that's a painful lesson, not a financial disaster. The people who make the second number catastrophic are the ones who made it 40% of their portfolio because they were excited in June 2026. Part 6. A clear decision framework before you act. Let's put this into a practical framework. Before you open your brokerage app tomorrow morning, walk through these 4 questions. In order. Question 1. Is my financial foundation solid? Do you have 3 to 6 months of living expenses in a savings account you can actually access? If not, start there. No IPO, no matter how historically significant, changes the math on having a safety net. Emergencies don't check what the Nasdaq is doing before they arrive. Question 2. Am I carrying high-interest debt? If you have credit card balances at 20% or 22% interest, paying that down is a guaranteed return that SpaceX cannot compete with. There is no investment that reliably beats the certain benefit of eliminating a 20% interest rate. Address that before you buy any individual stock. Question 3. Am I investing regularly in diversified funds first? If your index fund contributions are automated and consistent, you have a foundation. Adding a small, defined individual stock position on top of that foundation is reasonable. Adding individual stocks instead of that foundation is a different situation entirely. Question 4. If this goes to 0, am I okay? This is the question that clarifies everything. Not could this go to 0, SpaceX almost certainly won't go to 0. But if this specific investment lost everything, would my financial life still be intact? If the answer is yes, you've sized it appropriately. If the answer is no, or even maybe, you're overexposed. If you can check all 4 of those boxes, foundation solid, debt managed, diversified base contributions running, and exposure appropriately sized, then participating in the SpaceX IPO is a reasonable choice for someone who understands what they're buying and accepts the risk. If any of those boxes is unchecked, the most powerful financial decision you can make tomorrow is not buying SpaceX. It's continuing to build the thing that will still be there for you when the next SpaceX comes around, and there will always be a next one. Conclusion. The clear head in the loud room. SpaceX is, by any honest measure, a genuinely extraordinary company. What it has accomplished in rocketry alone, reusable boosters, a launch cadence that would have been unthinkable 15 years ago. A satellite network connecting people across 160 countries is real, verifiable, and impressive. This is not hype. This is a functioning industrial enterprise, unlike almost anything that has ever entered the public markets. And that is precisely why it deserves a clear-headed evaluation, not an excited one. The most expensive financial decisions most people ever make are the ones they make quickly, in moments of collective excitement, without understanding what they're actually buying or whether it fits their actual situation. You are watching this video, which means you're already doing something most people don't do. You're slowing down and asking the right questions first. The company will still be there after tomorrow. The stock will trade every day it's open. There is no window closing on your ability to research this further, understand it better, or wait for the first quarterly earnings report before deciding. The one thing that is genuinely scarce is not the stock. It's the clarity to make a good decision about it. You have that. Use it. If this helped you think through the SpaceX decision more clearly, that's the entire goal of this channel. Drop a comment with one question you still have about how this works. I'll answer as many as I can, and the most common ones will become their own video. Subscribe if you want more of this plain, research-backed explanations of financial moments that actually matter. No noise, just the clear version. See you in the next one.